Hello and welcome to Boni's Life. It is great to have you with us. If you have been keeping an eye on the crypto markets over the past year, you might be feeling a little underwhelmed. Prices have been moving sideways. The wild volatility we have come to expect has faded, and that intense speculative energy that once defined the space seems to have packed its bags and left town. To many observers, it looks like a market that has lost its mojo. The party is over. Time to go home? But what if that is the wrong way to look at it? What if beneath this calm surface, the very foundations of the crypto world are shifting in a profound and permanent way? That is the provocative argument made in an article published today in the South African Business Day newspaper by Heath Chena, the founder of Proudly Associated. The article is titled "Behind Crypto's Sideways Market, Structural Forces Are Shifting." And today, we are going to take that article apart, piece by piece, test its claims against the best available data, and give you a picture of what is really happening in the crypto market that the mainstream headlines are completely missing. Muchena's core thesis is elegant and counterintuitive. He argues that crypto did not stall, it reset. While the retail-driven frenzy cooled off, a series of powerful, less visible forces moved into place beneath the surface. These are the conditions that, historically, have preceded major expansions. Liquidity stabilized, leverage quality improved, long-term holders dug in deeper than ever, and geopolitical forces began expressing themselves through capital flows rather than through headlines. In other words, the quiet was not the sound of a dying market. It was the sound of a market building its foundation. Let us start with his first major claim, which is about global liquidity. Muchena argues that crypto has never been driven by interest rates alone. It responds to liquidity. Over the past year, central bank balance sheets stopped shrinking at the aggressive pace we saw earlier. Reverse repo facilities drained back into the financial system. Fiscal borrowing continued, but markets absorbed it without disruption. While policy rates remained high, financial conditions eased at the margin. And historically, when liquidity moves from contraction to neutral, risk assets stop falling. They do not necessarily rally immediately. They stabilize, compress, and wait. That, Muchena says, is exactly what crypto did. Now, is this accurate? The data largely supports it. Pantera Capital, one of the most respected crypto-focused investment firms, published their 2026 market outlook in January. The general partner, Cosmo Jiang, confirmed that 2025 was not a fundamentals-driven year for crypto returns. It was a year where macro conditions, positioning, flows, and market structure effects were the dominant drivers. The Federal Reserve stopped quantitative tightening, and liquidity conditions began to improve. Bitcoin finished 2025 down only about 6%, while Ethereum declined roughly 11%. But the broader token universe was devastated, with the median token declining 79%. It was an exceptionally narrow market, dominated by Bitcoin's unique position as digital gold, with mechanical demand from sovereigns, governments, ETFs, and corporate treasuries. So Muchena is right that liquidity conditions shifted. But here is the nuance he does not fully explore. The liquidity picture was disrupted dramatically in January 2026 by two events that most people are not talking about. According to Amina Bank's research, on January 20th, Japan's government bond market entered acute stress. 30-year Japanese government bond yields surged more than 30 basis points to 3.91%, the highest level in 27 years. Japan's debt-to-GDP ratio already exceeds 250%, and this triggered a rapid unwind of the yen carry trade, one of the largest sources of cheap global leverage. Investors were forced to liquidate risk assets, including Bitcoin, to meet margin requirements. Bitcoin fell below $91,000, not because of anything happening in crypto, but because it was being used as a liquid asset for balance sheet repair. Then, on January 30th, the nomination of Kevin Warsh as the next Federal Reserve Chair sent shockwaves through global markets. Warsh is known for his preference for higher real interest rates and a materially smaller Fed balance sheet. Within 24 hours, the total cryptocurrency market capitalization declined by approximately $430 billion. Bitcoin fell roughly 7% in a single session. This was a repricing of global dollar liquidity expectations, not speculative panic. Now, let us move to Chena's second major claim, which is about the internal structure of the market. He says on-chain data reveals a market that is structurally different from previous cycles. Long-term holders control a larger share of Bitcoin supply than ever before. Exchange balances continue to decline. Realized capitalization has risen steadily without the speculative spikes seen near prior peaks. The weak hands have largely exited. This is where the picture gets more complicated. Glassnode, the leading on-chain analytics firm, has been tracking these dynamics closely. Their data does confirm that long-term holder supply remains largely dormant, suggesting core investor conviction is unchanged. However, their Bull Score Index, which measures on-chain activity, has recently fallen to what they describe as extremely bearish conditions. Spot Bitcoin volumes remain structurally weak, with the 30-day average still depressed even as Bitcoin rolled over from $98,000 to $72,000. Glassnode frames the market as vulnerable until spot participation returns, and that participation will not materialize from derivatives normalization alone. So while Chena is correct that the long-term holders are entrenched, the absence of new spot demand is a critical gap. The foundation is strong, but the building has no new tenants yet. This brings us to the derivatives market, where Chena argues that leverage has changed character. He says funding rates remained broadly neutral, open interest grew slowly rather than explosively, and liquidation events became shorter and more contained. This, he argues, is leverage used for hedging and capital efficiency, not blind speculation. Van X. Matthew Siegel, one of the most respected voices in institutional crypto research, published a detailed analysis on February 9th that largely confirms this view. Even in the context of the recent crash, Siegel describes the February sell-off as orderly deleveraging rather than capitulation. Bitcoin futures open interest fell from roughly $61 billion to about $49 billion in just a few sessions, a decline of more than 20%. From its peak above $90 billion in early October, the market has now shed over 45% of peak leverage. The key word here is orderly. This is not the chaotic cascading liquidation events of previous cycles. The plumbing held. But here is something Chena does not address, and it is arguably the most fascinating hidden dynamic of this entire crash. Arthur Hayes, the co-founder of BitMEX and one of the most influential voices in crypto, has identified a specific institutional mechanism that amplified the sell-off. Hayes points to structured financial products linked to BlackRock's iShares Bitcoin Trust, known as IBIT. Major banks issue structured notes that give institutional clients exposure to Bitcoin with built-in risk management features, such as principal protection levels. When the market price dips low enough to trigger these predetermined levels, the dealers must aggressively sell the underlying asset to remain risk neutral. This is called delta hedging. In traditional equity markets, this is standard practice. But in the crypto market, it creates a powerful feedback loop. Selling forces the price down, which triggers more forced selling from other structured products, which pushes the price down further. Hayes is clear that this is not a conspiracy. There is no secret plot to crash the market, but these derivatives do amplify volatility in both directions. This is the hidden cost of institutional adoption. The same products that bring billions of dollars into the market also introduce complex mechanical risks that most retail investors do not understand. On February 5th, Bitcoin registered a negative 6.05 sigma move on the rate of change Z-score. To put that in perspective, the COVID crash was negative 9.15 sigma, and the FTX collapse was negative 4.07 sigma. February 5th, 2026 ranks among the fastest single-day crashes in crypto history. Bitcoin is currently trading at negative 2.88 sigma, below its 200-day moving average, a level not observed at any point in the past 10 years, including during COVID or the FTX collapse. 0% of historical observations have been further below the 200-day moving average. That is how extreme the current dislocation is. And yet, 90-day realized volatility sits near 38, roughly half the levels observed during the 2022 bear market when it exceeded 70. This is the paradox of the new market. The crashes are fast and deep, but the overall volatility profile is lower. The market is more efficient at absorbing shocks. This is exactly what a maturing market looks like. Now, let us talk about the geopolitical dimension, which is perhaps the most underappreciated aspect of Chena's analysis. He argues that sanctions, trade fragmentation, and selective access to dollar liquidity have turned capital into a strategic tool. In this environment, neutral financial rails gain relevance. Crypto's appeal is no longer primarily ideological, it is increasingly functional. This is a critical point. When a nation is cut off from the SWIFT messaging system, how does it conduct international trade? When a country's currency is in free fall due to hyperinflation, how do its citizens protect their life savings? For a growing number of people and even nations, crypto, particularly Bitcoin and dollar-pegged stablecoins, provides a viable, albeit volatile, alternative. It is a financial system that operates outside the direct control of any single nation-state, making it an essential escape hatch in an increasingly fractured world. This isn't just a theory, we see it in the data. The World Economic Forum, in a January 2026 report, described digital assets as being at an inflection point, noting that Singapore and the UAE have been first movers in digital asset regulation. Dubai is targeting on-chain processing for 50% of public sector transactions by the end of 2026. Crypto penetration in the UAE has reached approximately 39%, representing over 3.7 million users. Hong Kong has announced zero tax incentives on qualifying digital asset gains for funds and family offices. These are not speculative bets, these are sovereign strategies to attract capital and talent in the new digital economy. And here is the institutional paradox that Amina Bank highlighted so brilliantly. While crypto prices fell 25% in January, the infrastructure supporting institutional adoption accelerated at unprecedented speed. This is the story that nobody is talking about. BlackRock, the world's largest asset manager with over $10 trillion in assets, formally identified digital assets and tokenization as a defining investment theme for 2026, placing it alongside artificial intelligence. This is not a casual mention. This is a core strategic directive from the most powerful financial institution on the planet. They are not just buying Bitcoin, they are building the pipes, the custody solutions, and the legal frameworks that will allow trillions of dollars of institutional capital to flow into this asset class over the next decade. Franklin Templeton, another giant, described 2026 as the beginning of a wallet-native financial system. This is a profound concept. It envisions a future where your ownership of stocks, bonds, and even your house is not just a line item in a brokerage account or a paper deed in a filing cabinet, but a unique digital token that you control directly in your own digital wallet. This represents a fundamental shift in property rights and financial intermediation, a multi-decade trend that is just getting started. Y Combinator, the legendary startup accelerator that gave us companies like Airbnb, Dropbox, and Reddit, announced it would start funding its new batch of startups in USDC stablecoins. The US SEC rescinded accounting guidance that had discouraged banks from offering digital asset custody. And perhaps most significantly, the Depository Trust and Clearing Corporation, the DTCC, launched a production-grade tokenization program for US Treasuries, large-cap equities, and ETFs. For those who don't know, the DTCC is the invisible backbone of the US financial system, settling trillions of dollars in securities transactions every day. Their move to tokenize traditional assets is not an experiment. It is the beginning of the end for the legacy settlement system. It is the ultimate validation that the underlying blockchain technology is ready for the most demanding high-volume use cases in global finance. This is not just talk. This is the quiet, methodical construction of a new financial infrastructure happening completely independently of the daily price swings. The institutions are not here for a quick flip. They are rebuilding the system from the ground up. And what about the long-term price outlook? JP Morgan, in a report from February 5th, made a remarkable long-term call. They noted that the Bitcoin to gold volatility ratio has fallen to around 1.5, a record low, making Bitcoin increasingly attractive on a volatility-adjusted basis. The long-term volatility-adjusted price target for Bitcoin to match private sector investment in gold, which they estimated roughly $8 trillion excluding central bank holdings, is a staggering $266,000. They are clear this is not a prediction for this year, but it highlights the scale of the structural opportunity. They also noted that Bitcoin's current price is below their estimated production cost for miners of around $87,000, which has historically acted as a soft price floor. Now, for those of you looking at the next 24 to 48 hours and wondering what to do, let's get into the weeds of the technicals. This is where the rubber meets the road for active traders. As we speak, Bitcoin is consolidating in a tight range, roughly between $66,000 and $71,000. This range is critical. It represents a temporary equilibrium between the exhausted sellers and the cautious, opportunistic buyers. Let's break down the key levels for Bitcoin. The immediate and most critical support zone is the area between $64,000 and $66,900. This isn't just a line on a chart, it's a high conviction zone identified by on-chain analysts where a significant volume of Bitcoin was previously transacted. Think of it as a dense forest of buyers who are now defending their positions. A decisive break and close below $64,000 on a daily chart would be a significant bearish signal. It would suggest that this support has failed and could open the door to a retest of the February 5th lows around $61,000 and potentially even a move towards the psychological $60,000 level. For traders, a break below this zone would be a clear signal to either exit long positions or consider tactical short entries with a stop loss placed just above the broken support. On the upside, the first major hurdle is the $71,000 to $72,000 resistance area. This level has acted as a ceiling for the recent relief rallies. A convincing break above $72,000 would be the first sign that the bulls are starting to regain control. It would likely trigger a wave of short covering and could propel the price towards the next significant resistance zone, which is around $78,000 to $80,000. This area represents the breakdown point from the January 29th crash and will likely be heavily defended by sellers. A strategy for bullish traders would be to wait for a confirmed break above $72,000, then enter a long position with a target of $78,000, using the $71,000 level as a new support and a place for a stop loss. Now let's look at Ethereum. ETH has been hit harder than Bitcoin in this downturn, falling from its own highs and currently trading around the $1,950 mark. Its correlation to Bitcoin remains high, but it has its own distinct technical landscape. The key support for Ethereum is the $1,850 to $1,900 zone. This is a major psychological and technical level. A failure to hold this support would be extremely bearish and could see ETH quickly fall towards the $1,700 area. For traders, this is the line in the sand. Any long positions should have a clear stop loss below $1,850. On the resistance side, Ethereum faces its first major test at the $2,100 level. A break above this would be a positive sign, but the real challenge lies at the $2,300 to $2,400 resistance cluster. This was a major support level that was broken during the crash, and it will now act as a formidable ceiling. A bullish strategy for Ethereum would be to wait for a break and hold above $2,100, targeting a move to the $2,300 area. However, given the broader market uncertainty, taking profits at that level would be prudent. So, to summarize the trading strategy for the next 24 to 48 hours, for both Bitcoin and Ethereum, the immediate posture should be one of cautious observation. The market is in a state of extreme statistical stress, as Van Eck pointed out. This means that while the downside risk is still very real, the potential for a sharp relief rally is also significant. For aggressive traders, small tactical long positions near the key support levels with tight stop losses could be considered. For more conservative traders, the best strategy is to wait for a confirmed breakout, either a break below the critical support levels to confirm the bearish trend, or a break above the initial resistance levels to signal a potential bullish reversal. Patience is a virtue in a market like this. Don't try to catch a falling knife, and don't be the first to jump into a rally that hasn't proven itself. Let the market tell you which way it wants to go. So, where does all of this leave us? Heath Chena's article in Business Day captures something important that most of the mainstream coverage is missing. The crypto market is not dying, it is transforming. The speculative retail frenzy has been replaced by a more complex, institutionally driven market. The leverage is cleaner. The long-term holders are stronger. The geopolitical case for a neutral financial system is growing every day. And the infrastructure being built by the world's largest financial institutions is creating a foundation that did not exist in any previous cycle. But let us also be honest about what the article does not fully address. The current sell-off is real and painful. The absence of new spot demand is a genuine concern. The complex mechanics of institutional products like ETF-linked structured notes introduce new risks that the market is still learning to navigate. And the macro environment, from Japan's bond crisis to the Wash nomination, has injected a level of uncertainty that cannot be wished away. The truth, as always, lies somewhere in the middle. The structural forces are real and powerful, but so are the short-term risks. The market is maturing, and with maturity comes complexity. The sharp, retail-driven cycles of the past may indeed be over. The next phase is likely to be slower, broader, and more persistent, shaped by balance sheet decisions rather than social media enthusiasm. As Chena writes, and I think this is the perfect way to close, those still waiting for old patterns may find themselves watching a new cycle unfold without them. Sometimes, the most important years are the quiet ones. And 2026, my friends, is shaping up to be one of the most important years in the history of digital assets. Not because of the headlines, but because of what is happening beneath them. That is all the time we have for today. If you found this analysis valuable, please hit that subscribe button, leave a comment with your thoughts on where the market is headed, and share this episode with someone who needs to hear it. Until next time, this is Boni, and you have been watching Boni's Life. Stay informed, stay sharp, and I will see you in the next one.